Most traders die in the markets not from a lack of knowledge. They die from a surplus of emotion. They read every book, they studied every chart pattern, they watched every video, followed every signal, subscribed to every newsletter, and still they bled out slowly, one bad trade at a time, until there was nothing left. I know, because I was one of them. But here is the thing nobody ever told me, and nobody ever told you. The market doesn't care how smart you are. It never has. It rewards something far rarer, far more difficult to master, and far more dangerous to ignore. It rewards those who have mastered themselves. There was a man born in 1877, trading with his own money before he was 15 years old, who figured this out, before Wall Street had glass towers, before algorithmic trading, before the Bloomberg terminal, before any of it. His name was Jesse Livermore, and the strategy he used to make and lose and make some of the greatest fortunes in the history of American speculation again still works today. Not because the markets haven't changed, they have, but because human nature has not changed one single degree. And that is what we are going to talk about today. I want you to stop just for a moment and think about the last trade you regretted. Not the one that lost money. Losing money is part of this business. I mean the one where you felt it in your chest that you were making a mistake, and you did it anyway. Maybe you held a losing position too long, praying it would come back. Maybe you doubled down when you should have cut. Maybe you chased a breakout that had already run its course, entered too late, told yourself the story was still intact. Maybe you saw the warning signs and ignored them because you needed the trade to be right. You needed it. That word need, that is where the destruction begins. I have sat across this market for a long time, long enough to watch brilliant men go broke, long enough to watch modest men get rich quietly and consistently, without fanfare, without complexity. Long enough to understand that the gap between those two groups has very little to do with intelligence and almost everything to do with psychology. The great Jesse Livermore, who in 1929 made nearly $100 million selling the market short during the crash, while the rest of Wall Street was being carried out on stretchers, once said something that has lived in my mind for years. He said, "The game of speculation is the most uniformly fascinating game in the world. But it is not a game for the stupid, the mentally lazy, the man of inferior emotional balance, or the get-rich-quick adventurer. They will die poor. They will die poor." He was not being cruel. He was being precise. And in this video, I want to share with you what I have learned, studying Livermore's methods, practicing them in real markets, across real cycles, watching them hold true in bull markets and bear markets, in the age of the internet and the age of high-frequency trading, because the principles he discovered are not tactics, they are truths. They are observations about human nature and price behavior that exist outside of time. This is not a technical tutorial, this is not a list of indicators, this is something older than that. This is about how to think, how to wait, how to see, and how to survive. Let me tell you something that took me years to accept fully, at a deep and cellular level. The market is not your enemy, volatility is not your enemy, even the institutions, the hedge funds, the banks, the dark pools running their algorithms, they are not your real enemy. Your real enemy wakes up when you wake up. It looks back at you in the mirror every morning, and it is wearing your face. The psychological damage that trading does to a person is unlike almost any other profession on earth, because in almost every other endeavor in life, effort is directly correlated with results. You work harder, you produce more, you study longer, you perform better. There is a feedback loop between discipline and reward that civilizes the mind and trains the nervous system. The market breaks that loop deliberately, systematically, without mercy. In the market, you can make every correct decision and still lose money, and you can make terrible, reckless, irrational decisions and still win, at least in the short term. And that short-term randomness, that disconnect between effort and outcome, is what corrupts the mind of the trader faster than any other force. Because what happens is this: a trader wins a trade, not necessarily for the right reasons, but they win. The brain floods with dopamine, confidence rises, risk tolerance expands, position sizes grow. The trader begins to believe, at a subconscious level, that they have found the answer, that they have the market figured out, that they understand something the crowd does not. And then the market takes it back, all of it, with interest, and the mind, now addicted to the feeling of winning, cannot accept that the money is gone. So it does what all addicted minds do. It reaches for the next fix, another trade, a bigger position, a faster entry, anything to get the money back, to restore the feeling, to prove that the first win was not a fluke. This is revenge trading, and it is one of the most efficient wealth destruction mechanisms ever devised by the human mind. Here is another thing that kills retail traders at an extraordinary rate: the seduction of certainty. We are, all of us, pattern recognition machines. Our brains were built over hundreds of thousands of years to find patterns in chaos, to make sense of randomness, to see the tiger hiding in the grass before it eats us. That capacity has allowed our species to survive, but in the markets it can be lethal, because the mind will find patterns even where none exist. It will see a double bottom and project a measured move. It will see a head and shoulders and declare the trend over. It will see 3 consecutive green candles and extrapolate a parabolic rally. It will construct narratives, beautiful, logical, convincing narratives about why this trade is different, why this setup is perfect, why this time the pattern will hold. And the market will shrug and do whatever it was going to do regardless. I have seen traders with years of chart study, encyclopedic knowledge of candlestick formations and Fibonacci levels, who could not turn a profit to save their lives. Because they had mistaken intellectual exercise for market reality, they had confused the map with the territory. And in the markets, when you confuse the map with the territory, you walk off a cliff with a smile on your face. Technical analysis is a tool, a language, a way of observing what price has done and making reasonable inferences about what it might do next. But it is a probabilistic language, not a prophetic one. And the moment a trader begins to believe that a chart pattern guarantees an outcome, that is the moment the market begins collecting the money that trader worked so hard to deposit. The crowd psychology. Livermore understood something about crowds that most people in his era had barely begun to articulate, and that most people in our era still fail to fully integrate. The crowd is always wrong at the extremes. Not always wrong in the middle of a trend. During the middle of a strong uptrend, following the crowd buying the dip, staying long, ignoring the noise, is often the correct behavior. The crowd is right about direction for long stretches of time. That is how manias form. That is how bubbles inflate. Everybody piling in, prices rising, the narrative growing louder and more seductive with every day that passes. But at the turning points, at the tops and bottoms where fortunes are really made or lost, the crowd is catastrophically, reliably wrong, because the crowd is emotional, not rational. The crowd is driven by fear and greed in their rawest, most unfiltered forms. The crowd buys because it sees others buying and does not want to be left behind. The crowd sells because it feels pain and cannot tolerate one more moment of uncertainty. The crowd is a trauma response engine. It is not an analysis engine. And here is what makes this so dangerous for the individual retail trader. When you sit at your screen, alone, watching the tape move against you, watching your account value fall, hearing the news anchors declare the end of the world, the crowd psychology does not stay outside. It comes inside. It seeps into your thinking. It whispers that everyone is selling because they know something you don't. It tells you the rational thing, the smart thing, the safe thing is to do what everyone else is doing. That whisper has destroyed more trading accounts than any single market event in history. I need to say something about ego, because it is the most invisible and the most destructive force in a trader's psychology. Nobody talks about ego in the context of trading. They talk about strategy, they talk about discipline, they talk about risk management. But ego sits underneath all of it, quietly sabotaging everything. Ego makes a trader hold a losing position, not because the analysis still supports it, but because exiting would mean admitting they were wrong. and being wrong feels, to the ego, like dying. It registers in the nervous system as a threat to survival. So the brain, trying to protect the ego, manufactures justifications for staying in the trade. It cherry-picks supportive information and ignores contradictory signals. It calls a breakdown a fake-out. It calls an exit a shakeout. It finds reasons to hold on day after day while the position bleeds. I have watched traders sit in a losing trade for months, watching the loss grow from 2% to 5% to 20%, never cutting, never admitting, just waiting, praying that the market would come back and make them whole so they would not have to feel the shame of a loss. And sometimes the market does come back, and the trader feels vindicated, and they learn precisely the wrong lesson. They learn that holding on works. They learn that patience is always rewarded. And the next time they are in a losing position, they hold longer and longer, until one day the position does not come back. The greatest traders I have ever studied were not men without ego. They were men who had made peace with being wrong, who had separated their identity from their trades, who could take a loss with the same calm they took a profit because they understood that neither defined them. They were simply extracting probability over time. That is the separation. That is the gap between the professional and the amateur, not intelligence, not even skill. It is the ability to be wrong without it meaning anything about who you are. There was a moment in my trading life, and I suspect you will have yours, if you have not already, when everything shifted. Not slowly, not gradually, but all at once. Like the moment a fever breaks. I had just come through a period of losses that I do not care to fully describe. Significant losses. The kind that make you question not just your trading, but your judgment as a person. And I was sitting at my desk, very late at night, the screen still glowing, and I was trying to figure out what was wrong with my system. I went through my charts. I went through my entries. I went through my exits. I tried to identify the technical patterns I had missed, the indicators that had failed me, the signals that had been unclear. I was looking for the flaw in the method. And then something stopped me. A thought. A quiet, devastating, completely simple thought. There is no flaw in the method. The flaw is in me. The method was sound. The setups were there. The analysis was, more often than not, directionally correct. But between the analysis and the execution, in that thin, invisible space where thought becomes action, something was happening that I had never examined closely, never audited, never held up to the light. I was not trading my system. I was trading my feelings, my fears, my hope, my need to be right, my terror of being wrong, my impatience, my greed. All of it, all that psychological noise was overriding every logical decision I made, and I had not even seen it happening. That night, I stopped reading charts. I started reading about the mind. Institutional traders, the professionals at major funds, the trained operatives at the big banks, the experienced desk traders who have been doing this for 15 or 20 years, they operate differently from retail traders in one fundamental way that has nothing to do with capital or access to information. They think in terms of process, not outcome. A retail trader judges a trade by whether it made money. Did this trade work? Yes or no? Good trade or bad trade? And that verdict determines their confidence, their state of mind, their next decision. Their entire relationship with the market is outcome dependent. An institutional trader judges a trade by whether it followed the process. Did I execute according to my thesis? Did I enter where I planned to enter? Did I size correctly relative to my risk parameters? Did I exit when the thesis was invalidated, or did I let it run when it was confirmed? If the answer to all those questions is yes, the trade was good. Regardless of whether it made money, this sounds abstract. It sounds almost philosophical, to the point of being impractical, but it is the most practically important distinction in all of trading psychology, because the only thing a trader can control is their process. The outcome belongs to the market, always, without exception. And when you begin to build your trading identity around process rather than outcome, something extraordinary happens. The fear of being wrong starts to dissolve. Because being wrong on a single trade does not mean the process failed. It means the market did what it was going to do. And your job, your only job, is to execute the process correctly over a large enough sample of trades that the edge in the process reveals itself in the results. That is probability thinking. That is the institutional mindset. And it changes everything. Livermore spent enormous amounts of time not trading. This is perhaps the most underappreciated aspect of his method. The man who made and lost fortunes in some of the most volatile markets in American history was, in practice, deeply inactive for long stretches of time. He waited, he watched, he studied the tape, he let the market speak before he responded. Modern trading culture has completely inverted this principle. The entire ecosystem of retail trading, the streaming charts, the alert services, the Discord groups, the social media accounts posting 10 setups a day is built on the assumption that more activity equals more opportunity equals more profit. It is a lie, and it is an expensive one. Overtrading is one of the most consistent destroyers of retail trading accounts. Not because each individual bad trade is catastrophic, but because the cumulative effect of taking mediocre setups, of forcing entries when the conditions are unclear, of letting boredom or impatience drive the decision to enter over time, it grinds down the account like water on stone. The greatest setups in any market are rare. Not impossible to find, but genuinely rare. They require specific conditions to align. They require the price to be in a particular location, the trend to be in a particular phase, the risk-to-reward ratio to be genuinely favorable, the market character to be suitable for the strategy. And when all those things come together, when the setup is truly there, a disciplined trader can afford to size up with conviction because the probability is genuinely on their side. But you cannot find those setups if you are already in 3 mediocre trades. You cannot act with conviction if your account is already stressed. You cannot see clearly if you are already emotionally compromised from a string of unnecessary losses. Learning to wait is not passive. It is the most active form of discipline a trader can practice. Risk management is not a defensive strategy. In the minds of the truly great traders, risk management is the offensive weapon. It is the thing that keeps you alive long enough for your edge to matter. Livermore used to talk about a concept that I think is still the most important single idea in speculative trading. He called it the line of least resistance. The idea that price, like water, will always follow the path of least resistance. And a trader's job is not to fight that path, but to identify it and move with it. And the way you stay in the game long enough to identify that path consistently, the way you survive the inevitable periods of loss and uncertainty and drawdown that are the permanent texture of this business, is through rigorous, unapologetic risk management. Not cutting losses at the level where it hurts, but at the level where the thesis is clearly wrong. Not risking more on a trade because you feel strongly about it, but sizing according to your plan regardless of how you feel. Not averaging into a losing position because you have become emotionally attached to being right, but treating a loss as information, clean, neutral, emotionless information that the market has given you, and adjusting accordingly. I have a rule that has saved my trading life more times than I can count. Preserve capital above all else. A trader with capital can always come back. A trader without capital is finished. There is no heroic recovery from zero. There is only starting over. So the primary directive above profit, above winning, above any individual trade or sector or story is stay in the game. The last piece of the transformation is the hardest. It is also the most liberating thing I have ever experienced in this business. It is the practice of complete and genuine detachment from outcomes. Not fake detachment, not the performance of not caring while actually caring desperately, real detachment. The kind that comes from internalizing, truly accepting at the deepest level that you cannot control what the market does, you can only control what you do. And what you do, your entries, your exits, your position sizes, your adherence to your process is all that matters. When I am in a trade that is going against me, I no longer feel the desperate, chest-tightening need for it to reverse. I go back to my thesis. I ask whether the reason I entered still exists. If it does, I hold. If it does not, I exit, not with anger, not with shame, with the clean, practiced motion of someone following a process. And when I am in a trade that is going in my favor, I no longer feel the urge to take profits early, to lock in the gain before the market can take it back. I let the position run as long as the thesis remains intact. I trail my stop. I give the trade room to breathe. I let the line of least resistance carry the position as far as the market is willing to take it. This is not natural. This is trained. This is the result of years of self-observation, of journaling every trade, of studying my own emotional patterns the way Livermore studied the tape. It is a craft, and like any craft, it requires dedicated practice to master. But when you get there, when you achieve even a fraction of that emotional equanimity, the market becomes a different place entirely. It becomes a laboratory, a beautiful, endlessly complex, endlessly fascinating laboratory. And you become a scientist, not a gambler. Every era of financial history has its own technology, its own vocabulary, its own instruments and platforms and information systems. The markets of Jesse Livermore's time were conducted in bucket shops and on the floors of exchanges, with hand signals and chalk and a strip of paper moving through a machine called the ticker. The markets of our time are conducted across fiber optic cables at speeds measured in microseconds, in algorithms and dark pools and liquidity aggregators and social media sentiment. The technology is different, the velocity is different, the actors are different. But the ghost that haunts the machine, that ghost has not changed one bit. It is still human nature, it is still fear and greed, it is still the crowd rushing in and the crowd rushing out. It is still the accumulation and distribution of large operators. It is still the eternal cycle of compression and expansion, of balance and imbalance. It is still, at its most fundamental level, a market of people making decisions under conditions of uncertainty and pressure. And because human nature does not change, the principles that Livermore articulated, the principles that Wyckoff mapped so brilliantly and Dow observed so carefully before them, those principles have not aged. They have not been made obsolete by computers or derivatives or cryptocurrency or any of the 100 innovations that have transformed the surface of the markets. They are observations about human behavior, and human behavior is the one constant in this business. Richard Wyckoff, who was contemporary with Livermore and whose analytical framework remains among the most powerful tools available to any serious market student, described the market in terms that stripped away all the noise and revealed the essential mechanical reality beneath. Large operators, the institutions, the funds, the informed money cannot buy or sell large quantities of stock the way a retail trader can. They cannot simply place a market order for 100,000 shares and expect the market to absorb it without moving significantly against them. The impact of their buying or selling, if conducted openly, would push prices far beyond the levels they are trying to achieve. So they are forced to be invisible. They must accumulate positions slowly, quietly, in ranges where the retail public is confused, bored, or frightened. They must distribute positions carefully, in areas where the retail public is excited, euphoric, and rushing to buy. This is not conspiracy. This is mechanics. This is simply the reality of how large money moves through a market with finite liquidity. And once you understand it, once you can begin to read the signs of accumulation in a base, or the signs of distribution at a high, the market starts to make a different kind of sense. Livermore understood this intuitively, even before Wyckoff articulated it so clearly. He was always watching for what he called the pivotal points, the areas where price had spent significant time, where the tape had told a particular story, where the balance of supply and demand was clearly shifting, and he would not act until the price itself confirmed what he suspected, until the tape gave him permission to enter. In a world of infinite financial commentary, of pundits and predictions and analysis and opinions screaming at you from every direction simultaneously, there is one thing that never lies: the price. Not the explanation for the price, not the narrative around the price, not the forecast for where the price should be based on fundamentals or sentiment or macroeconomic analysis. The price itself right now, on the screen, as it moves. Livermore was, before all else, a tape reader. And modern tape reading, the study of price action, of order flow, of the behavior of price at key levels, is simply that same practice applied to contemporary markets. The tape tells you where the money is going, not where people say it should go, not where the analyst recommends it should go. Where it is actually going, right now, with real capital being committed in real time, and the tape will often tell you things that contradict every piece of analysis you have accumulated. The stock everyone says is undervalued continues to fall. The market everyone says is overbought continues to rise. The news is terrible, and the price goes up. The earnings beat expectations, and the price falls. These contradictions, the divergences between narrative and reality, between analysis and tape, are not confusing if you have learned to read them correctly. They are signals. They are the large operators doing what they must do, moving in the opposite direction of consensus, buying when the crowd is selling, selling when the crowd is buying. The traders who learn to follow the tape rather than the narrative, who can separate what they think should happen from what is actually happening, those traders stop fighting the market and start flowing with it. And that is when the relationship with trading finally becomes sustainable. Every market cycle in history has followed the same basic emotional arc. I have studied them going back as far as the historical record allows. The tulip mania of the 17th century, the South Sea bubble of the 18th, the railroad speculation of the 19th, the great bull and bear markets of the 20th, the technology bubble, the housing bubble, the crypto cycles. Every single one of them has moved through the same sequence of stages: accumulation, markup, distribution, markdown, and within each stage, the same cast of human emotions has played the same roles with startling consistency. In the accumulation phase, the public is absent or afraid. The asset is boring or damaged or misunderstood. The smart money is quiet, patient, building its position in the noise. In the markup phase, the trend becomes undeniable. Early adopters are rewarded. Confidence grows. The public begins to take notice. Momentum builds. In the distribution phase, the excitement reaches a peak. Everyone is talking about it. Stories of easy money circulate. New buyers pour in at the top, convinced they are early. The smart money sells quietly into their enthusiasm. In the markdown phase, the reality of the price cannot be ignored. The latecomers panic, the leveraged are liquidated, the narrative collapses, and the cycle prepares to begin again. If you can identify where you are in that cycle, not with perfect precision, but with reasonable confidence, you possess one of the most powerful analytical frameworks available to any market participant. And the tool that allows you to make that identification is not a formula or an indicator, it is an understanding of human nature. An understanding of how crowds think and feel and behave as they move through the stages of this eternal cycle. I want to tell you something that I have come to believe so completely that it has changed the way I approach every single trading day. The edge in trading is not a strategy. It is not a pattern or an indicator or a system. Those things are tools. They are necessary, but they are not the edge. The edge is discipline. Specifically, the edge is the gap between what you know you should do and what you actually do under pressure. Most traders, under sufficient pressure, under a large enough loss, or a large enough gain, or a sufficiently prolonged period of uncertainty, will deviate from what they know. They will let their psychology override their plan, and in that deviation, in that gap, they will give away whatever statistical advantage their strategy might have possessed. The disciplined trader narrows that gap. Through practice, through process, through the unglamorous daily work of building psychological habits and emotional routines that keep the mind steady when the market is trying to shake it loose. Livermore himself was not always a disciplined trader. He knew this about himself. He wrote about it with painful honesty. He made and lost enormous fortunes multiple times, in large part because he would occasionally abandon the principles he knew to be true, seduced by impatience or by the opinions of others or by his own emotional needs. and eventually, tragically, the market extracted the final cost of those lapses. His genius was in the principles he understood. His tragedy was in the consistency with which he failed to apply them. And perhaps no lesson in all of trading history is more instructive than that one. It is not enough to know. You must practice knowing until it becomes who you are. The professional speculator's ultimate goal is not to get rich. It is to survive, to remain in the game, to maintain the capital and the psychological clarity necessary to take advantage of the great opportunities that the market presents, not every day, not even every week, but with reliable regularity to the patient observer. Every market will, in time, produce setups of extraordinary clarity. Moments when the weight of evidence, the tape, the structure, the psychology, the cycle, all align and point in the same direction. Moments when the risk-to-reward ratio is genuinely exceptional. Moments when the trader who has been patient, who has preserved capital, who has kept the mind sharp and the emotions steady, can step in with size and confidence and participate in a move that compensates for months of careful, disciplined waiting. But you can only be there for those moments if you are still in the game. And that is the thing that most retail traders never fully internalize. They trade as though the current trade is the only one, as though running out of capital is not a real possibility, as though the market will always offer another opportunity at the same favorable terms. It will not. The market has no obligation to give you another chance. The market owes you nothing. It is as cold and as indifferent as the universe itself. So the professional's task, the real task, the one that sits beneath every strategy and every analysis and every thesis about what the market might do next, is simply this: survive, stay capitalized, stay clear, stay disciplined, be here tomorrow, be here next week, be here for the great opportunity that is coming, somewhere in the future, in the market that will reward the patient and destroy the reckless. Livermore, in his final years, wrote of trading as though it were a form of philosophy, a meditation on probability and patience, and the essential uncertainty of all human endeavor. He saw in the market a mirror of everything that was most human about us: our greed, our fear, our hope, our vanity, our capacity for self-deception, and our capacity for self-mastery. He was right on all counts. I have been in these markets for a long time now. I have had years that felt like grace and years that felt like slow punishment. I have been up when I thought I had finally figured it out, and I have been down when I was certain I had nothing left to learn. I have watched fortunes built and fortunes erased. I have watched brilliant people destroyed by their own certainty, and ordinary people thrive because of their humility. And if I had to distill everything, every lesson, every loss, every observation, every hard-won insight into a single sentence, it would be this: the market will teach you everything you need to know about yourself, whether you want to learn it or not. It is the greatest teacher there is. Not because it is kind, it is not kind. Not because it is fair, it is not fair. But because it is ruthlessly, perfectly honest. It does not care about your intelligence. It does not care about your credentials. It does not care about your analysis. It cares only about the truth of what is happening right now in the balance between supply and demand, between fear and greed, between the crowd and the operator. The traders who thrive in the long run are not the ones with the best systems. They are the ones who have done the deeper work, the inner work, the slow, unglamorous, unrewarded in the short-term work of building a mind that can think clearly under pressure, a nervous system that can hold a position without panic, and an identity that is not destroyed by a losing trade. That is the Jesse Livermore legacy that actually matters. Not the specific tactics, not the pivotal points or the leading stocks, but the understanding, the hard-earned, battle-tested understanding that this business begins and ends with the psychology of the operator, with the mind behind the trade. Jesse Livermore is gone. He has been gone since 1940, but the principles he discovered, forged in the crucible of the most volatile markets in American history, tested in bucket shops and on exchange floors, Across decades of triumph and ruin, those principles walk among us still. Every day, in every market, in every cycle, the ghost is still in the tape. And if you have learned to look, you will see it. If what I have shared with you today has landed, if something in these words has touched something you have felt in your own trading, something you have struggled to articulate, then I want you to stay. Not because I have all the answers. I do not. Nobody does. The market will always be larger and more complex and more mysterious than any single mind can fully comprehend. But I want you to stay, because the conversation we are building here is not about quick profits or hot tips or the next great setup. It is about something more important and more lasting than any of that. It is about mastery, the slow, patient, profound mastery of the one variable in this business that you can actually control: yourself. Subscribe if you understand that the real work is the inner work. Follow this channel if you are willing to go deeper than charts and indicators and strategies, to go into the psychology, the philosophy, the timeless wisdom that separates the survivors from the casualties in these markets. The next generation of great traders is out there. Maybe you are one of them. But they will not be great because of what they know about the markets. They will be great because of what they have learned about themselves. That is the only edge that cannot be programmed away, the only advantage that no algorithm can replicate, the only strategy that has worked in every market, in every era, in every cycle. Master the market? Perhaps. Master yourself? Absolutely. This is your edge. Go find it.